Hi, I'm George Nordhaus, and welcome to Monday Morning. Mergers and acquisitions, how to compete in a lively market. And this is a lively market. It's probably going to get more lively down the line. In fact, I'm going to ask Kirsten Petras, who's the sales director, and Brian Henson is underwriting director. It's Oak Street Funding. That's their strategic markets division, I guess, Oak Street Funding. Let's go and let me tell you about Kristen a little bit, or maybe let Kirsten, let her tell about it. Kirsten, will you? Okay. Who are you?
George, thank you so much. I'm Kirsten Petras. I'm the sales director here for the Strategic Markets Department at Oak Street Funding. For those of you familiar with Oak Street Funding, we've been lending in the insurance space for more than 13 years now. And about 5 years ago, we decided to expand deeper into the insurance market and focus on larger, more complex transactions and more mergers and acquisitions in the insurance market. So I joined around that time. I've worked in the financial services and banking industry since the mid-90s. The roles that I've been in are listed there, and certainly can expand on what my role here at Oak Street has been, as I've been here about 5 years. I have the pleasure of working with the majority of our clients that are part of our strategic markets portfolio. And the majority of those clients do come to us to fund mergers and acquisitions. We couldn't do any of this without Brian Henson, our underwriting director. And so with that, I'm ready to kind of let him introduce himself. Is that how you'd like to do it, George?
Yeah, but what I'd like to ask you before we talk to Brian, Marion University, where is that?
Marion University is here in Indianapolis, Indiana. It has been around for quite a long time. It was first Marion College, Franciscan University. It's gaining a lot of stride in the athletics division, and I'm proud to say that I'm a Marion University Knight.
There you go. Oh, good. Well, I'd heard of it a lot. I used to live in Indianapolis, but that was many years ago, so that's another story. Okay, yes, let's talk about Brian, or let Brian talk about Brian. Brian?
Sure. So I am the Director of Underwriting for Strategic Markets here at Oak Street. I've been here a little over 4 years now and helped grow the Strategic Markets division from a risk and analysis of large deal perspective. I have about 14 years experience in underwriting and credit at various, they're called super regional banks. Pretty much it's Mississippi East. With my last stop working on large transactions and participations in commercial real estate.
Got it.
So at Oak Street, I'm primarily looking at mergers and acquisitions, large loan transactions on the agency side, and then also a little bit on the program and MGA side. And I graduated from Purdue University with a Bachelor of Science in Management in 2002.
Got it. Well, let's see. That makes you blah, 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 blah. I always use, every time somebody says when they graduate, I don't say it anymore because I'm afraid it's going to poison people. But anyhow, I'm glad.
Well, I was in school for 2 years, George, so.
Oh, Purdue University, a heck of a good one. All right. Now let's talk about what's happening here in the merger acquisition business. Okay. Go ahead.
So I would say that we see quite a bit of prospects who are looking to expand strategically by acquiring throughout the country. And some are trying to gain market share geographically, some are trying to obtain additional markets. They have a variety of reasons for it, but it is definitely a movement that is afoot. And so what we're having the opportunity to see are the private transactions, not necessarily the large aggregator transactions that make the headlines. And so we have a unique perspective of how the individuals are taking an approach to this, what we see as some best practices that help the target acquisition process occur, as well as funding the transaction in the end. And so with that, Brian was going to go over kind of 4 considerations if your plan to grow is through merger and acquisition.
All right, Brian.
Yes. Yeah, so this would be tailored more to a small to medium-sized agency looking to acquire like-sized agencies. As Kirsten said, with the aggregators out there that are printing money, that can go out and pay high multiples and realize immediate synergies, it makes it harder for the medium to small-sized agencies to compete in this market. So some of the things we'll be talking about are recommendations or guidance of ways to get that accomplished. So with that, I'll go right into the slide here. So some things to consider. First is understand the motivation of the seller and either try to establish a relationship with the seller or the seller's broker. So understanding the motivation would be, are they looking to cash out and retire? Are they just trying to fetch the highest maximum sales price up front? Or are they willing to work for a period of time, be it 3 to 5 years as they gradually retire? Do they have friends and family in the business that they wish to remain employed?
Got it.
Do they have a name on the building, a legacy in the town, in the community, so that is keeping the name important to them? And so these are all things for a buyer to consider. So first things first, understand the motivation of the seller. The second thing, and this goes for all lines of business, but especially in insurance and M&A, is the seller and the broker want to make sure you have a plan of action and you can get the deal done. So I would say you have a buyer-seller, negotiate an LOI. You have a exclusivity arrangement for a period of time, call it 60 to 90 days. The seller doesn't want to go through the process more than one time. So the thing is to be prepared and have a plan of action so that you can close. So the first thing you would do, even before you were entering the LOI stage or you had an acquisition presented to you, is come up with a due diligence plan. Who in your organization is going to look at the agency, make sure it's a strategic fit, look for synergies? Will you engage an outside CPA or tax consultant? Do you have a lawyer? These are things to prepare before you even approach your first agency. The second thing is provide a fair bid, and we'll get with this on the what not to do slide, but be able to explain to the seller the rationale for the bid and why it may differentiate from someone willing to pay a higher price. Keep the diligence focused on the real issues and not dig into too much of the minutia. And if applicable, depending upon the size of the transaction, find an M&A advisor willing to help you get this done, especially if it's the first acquisition you've done or it's sizable or a little outside your box. You can get some value from having a third party or an extra set of hands there.
Does that include
and then
you?
Lastly,
excuse me a minute. Does that M&A advisor? Do you do M&A advising then?
We are not an M&A advisor. We are specifically a lender, but we have a bunch of relationships with M&A advisors, okay, and could recommend those based upon geographic and size if needed.
Okay.
And then the last thing on the size, and that goes into the next one, is get your financing line up beforehand. Know how much cash equity you have and want to bring to a transaction. Know how much a potential lender would be willing to bring. How are you going to structure the deal?
You know, when you were talking about the names a minute ago, that really rung a bell, because what you're seeing particularly with the aggregators and so forth, is do they retain their own name? There's some interesting movements in that area. I think particularly in New England, I'm seeing a lot of those things. We're working with an agency up there now, Cross Insurance, and they've got 41 agencies, but the agencies still have the agency name on it. They're not saying Cross Insurance. This thing seems to go up and down along that way. I asked the head of it, Royce, and he said we like to let our people, they're locally there, and we want to take advantage of the fact that they are there and have been there. So you see all kinds of things on this thing. It's interesting.
Yeah, we certainly do see that. There's a desire when there's especially a community connection to not disrupt that by something as simple as a name change. And then you have some people that it's very important to them as they're acquiring these that their name is reflected somewhere. But it speaks to the culture of the location and the culture of the business that they're acquiring. And if there's a cultural mismatch there, you know, it may not bode for a transaction that goes well. So asking about naming is an easy way to start to get some insight into what the seller is really feeling about how this change will impact their staff and the community and their clients.
Got it. Thank you.
You know, if I could expand on the first bullet point about developing a strong relationship with the seller, one thing we ask our applicants early on is, are they talking to all the decision makers? So this is a small world, and there are people that have relationships, and they'll engage conversations about acquiring somebody and then discover that that person isn't alone in their decision making, and that there are either equity partners or other people that may not even have ownership of the business that will be influencing the decision, and that it's not a difficult question to just ask if there's anyone else that they should be speaking to. And that can also help minimize any disruption from other players as you get deeper and deeper into this process.
Good. All right. I love that. Be willing to walk away. Yeah, that's tough. Yeah. That is tough.
So depending upon what study you read, and it's not industry specific, but certain advisors would say 50 to 75% of all M&A transactions fail. And we'll get over why some of those fail on the next slide.
Okay.
But if you've gone through your diligence and you feel that there's some issues, don't go through with the deal that doesn't make complete sense for your organization.
Got it.
Be willing to walk away.
Okay.
So one of the things I think that Brian is really trying to get across is that be intentional in this process with someone. That again, given existing relationships, we tend to approach some things quite casually, but it is a business transaction, and no one should fault you for having a plan, for wanting to talk about what post-acquisition life will look like and what their motivations are for selling, because that will just help you put together a more comprehensive plan to execute in terms of moving forward with acquiring the business.
Mm-hmm. Okay.
So we've went over sort of what to do, so let's go over a couple of things what not to do.
Okay.
And probably the first thing that caused mergers and acquisitions to fail is overpaying or over-leveraging a business. So when you're planning your diligence and going through deal structure and engaging with a lender, understand the equity requirement needed up front to get that done, how much debt you're putting on the business. One thing to consider when you're looking at a deal is negotiating the working capital up front, understanding when those commissions or fees come into the business, at what time of the month. Do you have to bring additional working capital, especially if it's an asset purchase, to cover payroll for 2 periods? These are all things that I think get brushed under the rug and aren't considered because everyone's focused on the actual structure of earn-out, cash out, and equity component up front.
Mm-hmm. Okay.
And the second thing that you probably shouldn't do is neglect the due diligence. And this goes back to the last bullet point on the last side, is be willing to walk away. If you find something in due diligence that arises, either go back to the seller, try to renegotiate the deal, sort of plan or mitigate around something that you found in the diligence. Don't just ignore something that you found just to get a deal done.
Mm-hmm.
And the third bullet point actually goes across all industries, and it's something that I think is pretty prevalent in insurance as well, is people overestimate synergies and expense savings. And so they can rationalize paying a higher multiple or higher purchase price and say, well, I can cut these employees, or I can close this location and save on rent. I can cut $100,000 out of the marketing and travel budget, etc. So make sure when you're looking at the financials and potential synergies to be conservative. And the agencies we see, I would say a typical EBITDA margin runs about 25%.
That's pretty.
So if you're estimating that you can acquire an agency and run it at a 50% EBITDA margin, maybe take a second look and try to rationalize that.
Yeah, that'd be nice to have one like that. But I don't know.
That's right.
You don't see many 50% EBITDAs, that's for sure.
That's correct. And the last item would be to fail to focus on the revenue. So a lot of acquisitions, especially on the agency side, like I just said, they're focusing on expense savings and how to rationalize paying a higher multiple or higher cost. But this is a people and relationship business, with retention being a very important component, because retaining a piece of business costs a lot less than winning a piece of new business.
Mm-hmm.
So look at the large customers, see if there's any concentrations there, figure out who the best producers are, how they're paid, do they own their books of business, if they were to leave, do they have non-compete, non-solicit agreements? And then the other thing is when you're purchasing an agency is when is it announced to the key producers what's going on? And then do you have a plan of action to make sure that it's a right culture fit? How are you going to integrate those producers into your management style, et cetera, to make sure you retain the business? And then the other thing is if you're going in, cutting CSRs, closing a location, cutting producers, et cetera, do you have the right infrastructure in place to provide superior customer service going forward?
Got it. Let me ask you guys a question. If I'm buying an agency, or if I want to start buying agencies and everything else, would I come to you for advice and checklists and so forth? If I'm a seller and somebody's talking to me, would I come to you for checklists and so forth?
Yes, we do have, actually we talk to sellers quite often because on our website we offer an agency exchange. And so we have a person here who engages with many sellers across the country, and it's a free service where they can list their agency for sale. And in doing that, we talk about what's the, how does their agency show? Mm-hmm. Where do they need to maybe tidy up? And, we know what we typically want to see from a seller in terms of financials and in terms of book of business information. And so we may share that with them at that stage so that they are familiar with the process as well. This process does typically include some level of seller's participation, and so we try to set the right expectation with our borrowers, but also the sellers that we come across, and let them know what their role may be as a buyer is retained for purchasing their agency.
Okay, thank you. So let's talk about Oak Street a little bit here, if we may, if you guys are okay with that. Let's look at
sure.
Let's look at the next slide here and see Oak Street, I hope. Come on.
One thing before going to the next slide, I did want to just mention one thing. As we continue to have relationships with our borrowers who have acquired, is we ask questions around how the integration has gone. Mm-hmm. And we've, Brian touched on that and being able to address who the staff is when those announcements happen. But I think that's another piece of the process that needs to be kind of mapped out and thought about. Are there redundancies in staff? Are there phone systems that need to be integrated? Are there agency management systems that need to be integrated? And then who's going to lead those projects? What are the timelines for them? And how can you do that with minimal disruption of both your employees' morale, culture, and client experience?
Good.
So some other piece to be focused on and not ignore it as part of the acquisition.
Got it.
But with that, I will speak to a little bit of who we are at Oak Street. And if we had to describe it in 3 bullet points, it would be the 3 that are on that slide. And if I could focus a little bit about what it means to us to be technology-driven. Technology-driven to us is how we approach underwriting our loans. Unlike most lenders, we ask not just information around the financial health of our borrowers, but we ask pretty in-depth questions around their books of business, their carrier relationships, retention rates, loss ratios. We get pretty deep into what that book of business looks like because we have our own actuarial modeling That is the technology we use to be able to start the loan structure process. So products that are being written can play a role in how long we lend, and those same products can play a role in how much of a revenue multiple we would lend. And all of that is balanced with the capability of cash flowing. So that is what we mean by being technology driven. We're getting under the detail, almost to the policy level of these books of businesses to be a key component in structuring our loans. We do have an experienced team with very low turnover, which we're quite proud of. We've been celebrated many years in a row as one of the best places to work in the state of Indiana. And we follow what we call our E-squared experience, which is basically if the employees are engaged in doing a good product, that it will resonate to the client experience. And being able to have a tenured team who has seen a lot of transactions, they bring a lot of real deal experience to the conversation. Of course, low turnover does minimize just overall disruption for our client. And our entire staff is made up of people who have a combination of not just lending experience, but also insurance experience. So we have firsthand expertise in these products so that they are the best facing product for our clients. Being flexible and accessible and responsive basically is easy for us to do because we do work very closely together. We are all in one location. We service the loans from origination through full payoff at the end of a term. All of that happens within the same four walls of this office. And we take a real team approach to our relationships so that there are multiple people working with each client so that they know that if one person isn't available, there is somebody else there. They don't necessarily have to retell their story for each person that answers the phone, and their overall client experience is enhanced that way. And that is evident in the fact that we have 23% of our clients have come back to us in the last year for additional acquisition funding. And we are able to also maintain a high Net Promoter Score. A Net Promoter Score is primarily a customer satisfaction score. We survey each one of our funded loans, and that survey includes a question about would they come back to us, would they recommend us to others, and they're allowed to give us a ranking. And our current Net Promoter Score exceeds 80%. And through the feedback that we have received through these surveys, we have been able to constantly gather up as a team and refine the process so that it's just improving time over time again for each client.
Well, all I hear is good stuff about you for many years. I've worked with Rick Dennon. I don't know how long has Rick been there, a long time as the president.
Well, Rick started this business in 2003. He still has the original business plan, sits right on his desk. Anybody in the office is welcome to go look at it. And you can tell it came off a typewriter. You would never see something like that nowadays. But the fact that he takes a lot of pride in starting this business and being here since day one. And a lot of the key senior teams have been here since inception. And so the fact that, there's a lot of pride in the overall growth of this company over the years is something we are all proud of.
Well, thank you. I've never heard one bad thing in those 16 years or 13 years, not one. That's pretty good, huh? I think so. So yeah. Proud of you guys. All right. Well, how do they contact you then? Now, if somebody's going to buy or sell, what's the next step? Let me see your contact. Yeah.
I'm sorry, I missed that with the high net promoter, but I did want to just kind of touch on a quick overview of who may be a good candidate to call us first.
Good, I jumped forward, excuse me, go ahead.
That's okay. We look at future fees and future commissions, and through that we're able to predict cash flows, right, and from that leverage a loan against those. Internally, we can do deals for as little as $25,000 up to $20 million. We have ability to go above $20 million if necessary, but internally, that's where we're processing deals. Terms can be up to 12 years. We have variable rates for the majority of our portfolio. However, we do have fixed rate options available, and we have, what we would call customized loan structures. As I mentioned before, we're going to look at that book of business, and that's going to play a factor into each loan structure, and we recognize that each agent does not have the exact same book of business as the next agent. And so with that, the loan structures are largely customized to what that book looks like. And through our team approach, for especially our strategic borrowers who are wanting to grow through acquisition, we're able to really refine a model for them that we can help them figure out as the structure they want to approach future buyers. That's going to be a combination of a leverage point, an advance rate, a debt service coverage ratio we want to be able to maintain. And that way they are empowered with some information that as they approach targets, as Brian was saying about being able to point out having financing or the money actually available to buy, they can show the target exactly how they're modeling out the overall down payment to them.
Let me ask a question about that fact. Do people come in and they're buying agencies that usually come, do you demand that they pay X dollars in cash or down payment or something like that? Or can they actually maybe a lot of the times just borrow against future fees, as you say, and not have to have a down payment?
Well, we did a little chart on the bottom right of this slide that sort of goes through a traditional structure, acquisition structure.
I see.
And so typically we require 5% cash down, 15% of it held in a subordinated seller note, usually matching Oak Street's term, and 80% from Oak Street. And now if you go back to one of the slides of what not to do, over leverage the business, we're going to make sure that that structure makes sense.
Okay.
That's sort of our tagline of I would plan on having 5% cash down.
Okay, good answer. Thank you. So.
But with that, as again, customized loan structures, everyone's situation is their own situation, and they may want the ability to reach out to one of us to float some scenarios by us. Our contact information is here. If there is someone who is considering selling their agency or their MGA and they would like to discuss that with the individual here who could give them access to our agency exchange and therefore get that out to the subscribers of our database, we'd be happy to put them in touch with her as well.
That's terrific. I want to thank both of you for this. It's been short, sweet, and to the point, and that's a good thing. And I think that this will be in our on Rough Notes and our Agencies Online's archive. I can't think of the word archive of the instances. You can always go back and refer to this, and I think I would if I were buying an agency or selling. I think I'd go in here and take a look at it. So thank you guys for this, and I will look forward to working with you more in the future as usual. And for the rest of you, I'll see you again next Monday morning.